You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, we are taping Options Playbook Radio. It is March 30th. The markets are closed. We had a little bit of a down day after, I think, 4 up days in a row. I've been talking a little bit about the VIX, and the VIX is befuddling to me. We actually see the VIX trading below the 200-day moving average. So you can make an argument that the VIX is actually in a low volatile environment that usually reverts to the mean. And the VIX is a very fast-moving index. So I always like to compare it to the 200-day moving average, which is, up around the 20% level. And so we see the market, the S&P 500 index today is down 29 points, or just over 0.5%. And we see the VIX trading at 1933. Now, there's a lot of geopolitical concerns. They're kind of waning just a little bit, but who really knows where that's going to go? But that isn't in the news nonstop as much as other things in the marketplace. We actually have the NASDAQ market was down over 1% today, and the talk about interest rates in the 10-year being at 2.3% and actually setting a high in quite some time, going almost touching the 2.5% range on the yield for the 10-year has made some news and brought up inflationary concerns once again. So inflation is taking over the headlines, and because of that, we're actually going to change up what we've been talking about recently on Options Playbook Radio, which are stock splits. We went in great detail about an Amazon stock split that is going to be happening in July. And then also inside the Ally Invest YouTube channel, I discussed about a month ago the Google stock split when it first was announced, and we looked at a long call spread in Google. So you can compare the two if you'd like. Last week we talked about Amazon in the podcast and the concerns that you might have if you're doing a stock split, but Amazon is up a little bit right now. No sense in really rehashing the trade until we get a little bit closer to the date of the actual stock split and see what happens with Amazon. Then we'll probably revisit that trade again. So today we're just going to jump right into it. We're going to get a little bit more conservative. There's always been people that have tried to say that Bitcoin is trying to replace gold as a hedge for inflationary and market concerns. But today we actually see, and I'm kind of rah-rah for gold. Gold was up 1%, and we saw that Bitcoin was down down 1%. It's had a kind of a rough time, a lot of the cryptocurrencies since the beginning of the year. So why not talk about gold? The chart isn't too amazing in gold, but we did recently come back and touch all-time highs not that long ago, only to fall down precipitously after that. So when looking at gold, there is a good ETF that tracks the price of gold relative to a lot of these ETFs or ETNs, if you will, that track commodities. The gold is considered to be one of the better run ETFs out there in the marketplace. And because of that, you have very liquid markets in the options marketplace. It's very heavily traded. The GLD is, I should name the symbol. And since the actual underlying is fairly liquid, we actually have pretty good markets in the options marketplace. So the GLD right now is trading at 180.58, and it makes it enticing to look at some option strategies because of the fairly decent markets that we have. Now, GLD has had a run up back in 2020, kind of backed off a little bit going into the new year. And recently we came up and touched the high that was set in 2020, right around the 194 level in GLD. But gold, considering all the concerns about inflation and the marketplace and geopolitical concerns, gold has actually just kind of been flatlined a little bit, besides that little spike up that we had. What date was that on? That was on March 7th, where we made a little bit of a spike up, a little bit of a move. And we didn't hang out very long over the 190 area, but now we're back down in gold today on the close, traded at 180.58. So, I think we're going to look at a fig leaf in gold, and we're going to approach it as a little bit of a protection strategy, maybe a little bit of a hedge inside your portfolio of stocks. And as always, this isn't meant to be a recommendation on Options Playbook Radio. We're just trying to take some of the plays within the playbook, and we've gotten pretty speculative recently, talking about like Amazon stock splits and some of the other strategies that we have addressed. So I always like to talk about the fig leaf. It's one of my favorite strategies in the Options Playbook. And another name for it is a leveraged covered call. And it basically means that we're going to buy a deeper in the money option contract as a substitute for owning the stock, which when you have a $180 stock, this is always, if you have a decent marketplace, this is always a consideration to buy a deeper in the money option as a surrogate for the stock. But on a stock, a lot of times people will think about selling a call against that position and try to capture some time premium. And I kind of like, because gold has been a little choppy recently, I think the fig leaf applies. So I'm going to go out to the July expiration. We're going to get out to the middle of the summer here, and we're going to look at the 169 call option. And I actually see the market 14 by 13, and the markets are close, so we're 30 cents wide. We got an 80 delta on that call option, so it is acting as a surrogate for the stock. We're going a little bit longer term, and we're accomplishing everything that we would like to accomplish if we're looking at a fig leaf. So we're limiting our risk to that $14, or let's call it $14.15. That would be the midpoint if we were able to execute that trade at the midpoint. And at the same time, I'm actually going to enter this all as one trade, because a lot of times, if I'm doing a covered call on a stock that I'm trading, or a fig leaf where I buy an option as a surrogate for the stock, I like to wait and see where the stock goes and then sell some premium against it. And in this instance, because of the way the chart is on gold and the choppiness of the trading, I really want to try to capture some time premium. And if we go a little bit out of the money and we target that recent high in gold, right around the 190 level, we can get some decent premium for it. So I'm proposing that we would actually enter this all as one trade, enter it as a spread, and we're going to look at the April 22nd expiration 190 call option, and I'm showing that right now is trading at 84 cents by 87 cents. Once again, the markets are closed. It is March 30th. It is a Wednesday. So decent markets in GLD, and that's what makes this a little bit attractive, and that's why I've talked a little bit about gold, is because we have such a good underlying to trade relative to the actual commodity. Okay, so right now, if I do the calculation, the midpoint of the spread that would be entering to the trading floor would be $13.30. So in this instance, for each 1-by-1 spread that you're doing, you're talking about paying $1,330 plus commission to put that trade on. And we're getting something that will act like the stock. We're going quite a bit out. If the stock is at 180.58 and we're talking about 190, so just under 10 points before our option contract would be in the money on the one that we're sold. And if you're doing a fig leaf, you really don't want to be assigned, because it's part of the reason why we call it a fig leaf, is that you're kind of covered. You have something that acts like the stock, but you don't own the stock. So if you're assigned, you're going to have to do something with that position. In other words, you don't own the stock, so either you have to exercise your option contract and get the stock, or more likely, you're going to want to go on out and buy the stock for that assignment. So if we're doing fig leaves, we want to have an alert set right at the 190 level. We do not want that option contract to be assigned, so you need to study up on rolling your option position, or maybe even just plan on closing it out, because if it goes to 190, you should be up on that trade. So there's a couple of ways, but you just want to have a plan. Whereas if I was doing a flat out covered call where I just bought 100 shares of the stock and I sold the 190 call against it, if it gets called away, that's okay. I literally can fall asleep and just let that happen. And I'm going to sell my stock just over 9.5 points higher than where the underlying market is at right now. Oh, well. All right. So fig leaves are a little bit more work than a covered call, but they're definitely an interesting trade. And that could almost make this a FOMO trade. I like the fact that we can get some premium for that 190 level. I'm kind of surprised to see that it's trading at 84 cents. As a matter of fact, the all-time high, as I mentioned via the chart on GLD, is right around 194, and you can still sell that for 50 cents. So you're still getting a decent premium, even going up to the 194 level, which if I'm looking at fig leaves, I'm always going to sacrifice premium because I don't need as much of it. I didn't pay as much as I did for the stock. So bringing in a little bit smaller amount to decrease the odds of being assigned, well, that's attractive in a fig leaf trade. So let's summarize the trade overall. We're looking at gold. Gold closed today at 180.58. It was up $1.44. Good old GLD. We're going to go out to that July 15th expiration. We're going to buy the 169 call. And at the same time, in the same trade ticket, we're going to sell the April 22nd expiration 190 call, looking to get this trade done for a net debit of $13.30, which is the midpoint. So you can't always guarantee a midpoint fill of $13.30 for the account. The total cost of the trade would be $1,330 plus commission. That is my maximum risk on that trade once I pay that net debit for the account. We're hoping that gold will stay below 190 before that April 22nd expiration, but we're going to have a plan. If it gets to that expiration where they're going to roll up and out in time, if it gets to that strike, or we're going to close out the entire trade and just move on in that scenario. Now, on the downside, we are managing our risk by buying that option contract instead of buying the stock outright. But you can say to yourself that if it does get down to the strike, the 169 strike, your option contract actually gives you a little bit of a buffer in that. At 169, you'd have an at the money option. So I always, when I'm thinking about buying 80 delta option contracts as surrogates for the stock, I always want to, if it gets to that strike price, I usually will consider just selling it. Now, it depends if it happens sooner as opposed to later, because there would be more time premium in the option contract. And obviously, if it comes down to 169 from 180, well, my outlook on gold might be a little bit different going forward. So it's kind of just an easy spot to put a stop in on the downside for this trade. On the upside, we have an 80 delta, and as the stock goes up, we get more and more delta. So there's a lot of benefits to doing a deep in the money option contract on a liquid stock as opposed to just buying the stock outright. Now, the downside is that bid-ask spreads are a little bit wide. And if that wasn't the case, if we could have, nickel or dime wide deep in the money option contracts and on almost all the underlyings, right, you would see a lot of people that would do this. This is a very interesting strategy because you're flat out limiting your risk as compared to buying that option outright. And in this marketplace in gold, we have a 30-cent wide market with the markets closed, and that's not too shabby. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to try to address, you can send them directly to me at theoptionsguy@invest.ally.com. If you'd like to learn more about the educational events that we do at Ally Invest, please follow me on Twitter. My handle is @BrianOverby. And a little foreshadowing, we will be doing a listener question show. It's going to be coming up soon. We like to call them the Huddle Up. So please send your questions now, and maybe you will be able to hear the answer on our Huddle Up podcast. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.